What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. In this week's video, I'm going to be going over a very interesting segment of the Canadian financial sector, that being the subprime lending segment. I'm going to go over two stocks in particular in that sector that have absolutely exploded as of late, that being Goeasy Limited and Propel Holdings. Propel Holdings really coming out of nowhere. I'm going to go over my overall thoughts and feelings on the subprime market, why it's seeing such a huge surge in activity, and whether or not we're going to continue to see that surge moving forward. And then I'll dive deep into those two companies and kind of provide my thoughts as to whether or not there's still a bit of room to move up there, or whether or not valuations are stretched. So with that said, let's dive right into the video. So everybody, as always, like the video, head down below, subscribe to the channel, and if you're a subscriber of the channel, drop a comment down below. Let me know what fund or stock you want me to look at next. And we are getting back into more routine videos here at Stocktrades. So I'm going to be drawing a free premium subscription. It's a $300 a year platform every single month to a random commenter on the channel. So you're not going to want to miss out on that opportunity. So just drop a comment down below. So subprime lending, what exactly is subprime lending? And that is in particular when those with lower credit scores who might not be able to qualify for, say, a prime loan or a prime mortgage, they might have to head to the subprime market, look for an alternative lender, and from there they can still qualify for a particular mortgage or a particular loan, but it might be at a particularly higher interest rate. Now, this segment of the market typically has higher risk loans. The charge-off rates are typically much higher with subprime lenders rather than a major Canadian bank, for example, and it typically offers loans to weaker Canadians financially, those who might be a bit more, cash-strapped, not have the best credit rating, or might have slipped up in the past in regards to loans. The one thing that people need to understand about the subprime market is that a lot of people make the assumption that Canadians or Americans, in the case of Propel Holdings that we'll go over, they're more US based, is that these consumers are typically, higher debt levels, and that isn't necessarily the case. In fact, often those who are going to the subprime market have lower debt levels than, prime borrowers. And one of the main reasons for this is, a lot of prime borrowers are mortgage holders, whereas a lot of subprime borrowers, they don't have mortgages, they don't own their home, they're renters, and for that reason, they typically do have lower debt levels. So don't automatically make the assumption that somebody who is trying to access the subprime market is always buried in debt. This isn't necessarily the case. They might just have a poor credit rating, a history of not making payments, or just don't have the income to maybe qualify for a prime mortgage, so they have to head to these markets. Now, one of the main downfalls from a consumer perspective, or just overall an investing perspective, or a reputation perspective for a lot of these companies, is a lot of people view these loans as predatory, and they are crazy high interest rates for the most part. I mean, some of these loans have, 30% plus APRs, pretty much the annual interest rate that you're going to pay on these loans. In fact, the Canadian regulators had to step in and actually reduce the amount of, level of APR that these companies can charge. They cut it back to 30% so that Canadians can get some relief in that regard, because a lot of these loans are very, very difficult for Canadians to pay off. They have sky high interest rates. They're typically, kind of a olive branch to those who, they won't get approved normally. So these companies, in order to kind of offset the higher risk of these borrowers, they charge absurd interest rates. And for that reason, many Canadians just outright avoid these companies. They don't like the business practice. And if that's you, I can appreciate that. But ultimately, there is a lot of growth with these companies. And when we go over Goeasy and Propel, you're going to notice that very quickly. These companies' earnings have absolutely skyrocketed in today's economy. And before I get to those two companies in particular, I actually want to go over why exactly this is. And typically, these subprime lenders will thrive more during a weaker economy, and particularly particularly the economy we're in right now, where costs of living are absolutely skyrocketing, consumers are needing to access capital, whether that be through a credit card, whether that be through a line of credit, or whether that be through a subprime loan. And you're going to notice when I go over these two companies, loan originations are through the roof. They're seeing record amounts of loans. They're seeing record amounts of customer additions. And I really do believe this is because of how many consumers, how many, middle to lower class Canadian and Americans are struggling right now financially, and they're having to tap into this type of market in order to access capital, whether it be to afford their mortgage, afford their rent, afford their food, sadly enough, in the state we're currently in. So as a result, the weaker the economy is, and there's a fine balance here in regards to an economy that is strong enough where charge-off rates for these companies remain relatively steady. They're always going to be higher than normal, but we don't want to see that creep up. And thus far, we're not necessarily seeing that creep up, but we're definitely seeing loans rise. Credit card balances are rising, subprime lending is rising, and it's pretty clear that many consumers are beginning to struggle or have been struggling for quite some time, and they're tapping into this market, which is causing huge earnings growth among these companies. My overall outlook of the subprime market is when we see economic strength, maybe we see, better wage growth, maybe we see inflation slow down, there is a chance that, lending in this area might actually begin to slow. Whereas now, the weaker the consumer, the stronger this area is going to continue to be, in my opinion. Now, do record loans on record customers always translate into higher earnings for these companies? No. As I mentioned, there needs to be a fine balance between strong underwriting and also maintaining, charge-off rates, keeping those customers paying those loans, because ultimately the top line for these financial institutions can grow all you want, but when the bottom line doesn't grow, we're seeing this with many of Canada's major banks right now, the top lines continue to grow because interest rates are at absurd levels, whereas the bottom lines are really struggling because of higher provisions. If this begins to be the case for these subprime lenders, they're going to face a ton of volatility from the market, but it hasn't been the case yet. Now, with all that said, let's dive right into two of the most popular ones as of late, that being Goeasy Limited and Propel Holdings. Now, I'm not going to go over Equitable Bank in this video. I don't really classify them as the same, sector as these two companies. A lot of people view Equitable as an alternative lender, yes, but ultimately that company is more of a deposit-based bank with some B-grade mortgages mixed in, a multitude of other products that, Propel and Goeasy don't really have. These two companies primarily focus on that subprime lending market. So the one interesting piece of data that I want to go over before I do get into Goeasy, and this is an article from last year, but I'm sure the data recently is still very relevant. I'm sure this is still relevant in 2024, but Canada has seen subprime borrowers become the fastest growing credit segment. The number of subprime borrowers jumped 9% year over year to hit 2.64 million in Q2 2023. High-risk borrowers grew at nearly double the rate of near-prime and prime borrowers, which grew 5%, and over 4 times the rate of high-quality above prime borrowers. So this is kind of what I mean by the weaker the economy, the more you're going to see the subprime market grow. And at the start of this article, they highlight this. Higher living costs and rising rates have combined to produce higher risk borrowers. Obviously, the more stretched we are, the more we're going to need to tap into that financing. Now, when we go to Goeasy Limited, we can see, peaked in 2021, near the end of 2021 market peak. It went through, a multi-year downturn, but earnings have really started to turn around in the last year or so. And as we can see, 1 year returns, this stock has returned 90%. This trumps pretty much any major index you can imagine. And if we look to the most recent quarterly earnings, we can see, loan originations up 11.5%, gross consumer loans receivable up 28.8%, revenue is up 24.3%. I mean, look at operating income, we're looking at nearly a 35% boost, adjusted earnings per share up 23.5%. So this company is currently smashing it out of the park due to more more and more customers coming to the company. So the one interesting thing we're going to see here, and is what I've talked about, is the net charge-off rate currently sits at 9.1%. Now, you might think that this is relatively high, which it is compared to a major institution like, say, a Royal Bank. But for a company like Goeasy, this is actually a, very typical charge-off point for this company. It had these types of charge-offs, pre-pandemic. I think they actually might be a bit lower now than they were pre-pandemic, and they actually maintain this type of charge-off rate throughout even the COVID-19 pandemic, when a lot of people are unemployed, they were on lockdowns, things like that. Now, the company's guidance in terms of charge-off rate is between 8.9 and 9.5, so they're still well within that mark. So we look for, when we look to new customer acquisitions, record quarter for application volume, 613,000. That's up 41% year over year. You're looking at 40,000 new customers, up 17% year over year. Net lending volume to new customers represented 69% of total credit advances. That's up from 67%. So these aren't necessarily previous customers of Goeasy trying to tap into more financing. These are brand new customers coming to the company. Now, over the last few years, Goeasy has gotten into the automobile market as well. And, that's a relatively small segment of the business, but it's still, record quarterly originations exceeding 116 million. That's up 49% year over year. I mean, these might be people who need a new vehicle. They maybe can't get approved for dealership financing, so they come to a company like Goeasy. But I know Goeasy in particular sectors does actually work with the dealerships themselves. I mean, we can see increase the dealer network from 3,300 to 3,500. So overall, there is very few segments of this business that are not growing right now. Now, the one segment of the business that is not growing as well, and I would view this as more cyclical, more discretionary, would be its easy home segment. This is an area of the business where the company finances things like electronics, furniture, all that type of stuff, and you pay ridiculously high financing rates to own particular electronics or furniture to reduce the monthly payments versus buying it out at once. This segment of the business is pretty much flat, but the thing is, it doesn't really contribute overall a ton to, Goeasy's overall revenue mix. The bulk of it is going to be that loan segment, which is currently seeing huge growth. Now, the thing is, with a run up like this, we have to start to wonder whether or not valuations are stretched or whether or not the company is still a buy today. I mean, we have a market cap of $3 billion. This company is still very small. And when we look at valuations, we can see that they are getting up there, but the company isn't really all that absurdly expensive, even though it has risen 90% this year. And the prime reason for that is because of that earnings growth, because of the surge in popularity towards its loans. I mean, we can see the company is trading at 12.4x trailing earnings. This is, barely above its historical averages. When we look to 10-year median averages, it's trading pretty much right in line. And when we look to, from a PEG standpoint, which will compare its forward expected earnings to its current price, we can see that it's trading at 0.55. Typically, you want a company, anywhere around the 1 range, but under 1 typically is indicating that the market is not reflecting the company's future growth in its current stock price. And when we do look to estimates for Goeasy, we can see that it does expect pretty strong earnings growth moving forward. We can see when we look to 2024, we're looking at $16.91 compared to $14.10 in 2024. So this is, double-digit earnings growth. And then from, in 2025, they're expected to post earnings of $20.16, which again would represent, pretty strong double-digit earnings growth. And then even then in 2026, you're looking at $22.24, double-digit growth again. Now, the one thing I will say is it's very hard for analysts to be predicting into 2026. These are prone to change wildly, but overall, this company, despite its meteoric rise in 2024, is really not all that expensive on a valuation basis. Now, as I'm filming this, Goeasy dropped 9.9%. And the main reason for this is the CEO has decided to retire and they're replacing him. It was a bit of a weird dip on the news. I mean, I don't think there's anything alarming here in terms of, the CEO stepping down because of company issues, things like that. He hasn't really been with the company all that long. I believe he's been the CEO. He's been with the company for 14 years, but only the CEO for 6. And typically when we do get these, big dips on the change in company management, people tend to get spooked. It tends to be an overreaction in terms of the share price. This is a very strong earnings compounder. I mean, if we look at 10-year returns, it's returned 1,200%. If we look to max, like from when the company started publicly trading in the late 90s, we're looking at 4,100% returns. And I do think that this company does still have quite a bit of runway. I mean, we're looking at a 25% return on equity. It's just outstanding return on equity. The dividend, it is a very, very strong dividend grower. If we look at, the overall dividend growth of this company, we can look at 10-year dividend growth, 1,280%. This company has grown the dividend over the last 5 years, 10 years. If we look to 5 years, 277%. 3 years, it's grown the dividend by 77%. This is one of those prototypical, low-yielding, high dividend growers that has grown earnings per share at a crazy amount. I mean, if we look to diluted earnings, we're looking at earnings growth. It's just been outstanding the past bit. 10-year earnings growth, 1,000%. 5-year, 213. And this includes a big dip during the bear market of 2022. 3-year earnings growth, we're looking at, flat earnings growth, but again, that does include this, big drawdown in 2022. If we look at 1 year, it's bumped earnings by 37%, so there's been a big turnaround here. Overall, for Goeasy, I still really like the company. I still feel that the economy is going to be weak enough, the Canadian consumer is already stretched enough that there is going to be continued demand for these subprime lenders in Canada. But when we want to head to the United States market, and this has been a stock that has been in very high demand for me to go over, that is Propel Holdings. They are, again, another alternative lender, a Canadian-based alternative lender, but the bulk of their operations are going to be in the United States. So as I had mentioned before, Propel kind of came out of nowhere. This is still a relatively new company. It only went public in 2021. It had a huge surge in popularity in 2021, much like Goeasy would have, and then it really took a hit in 2022, much more than Goeasy. This is a much smaller company than Goeasy. It only has a market cap of around 857 million, whereas Goeasy is, at around 3 billion. And although, as I mentioned, this is a Canadian traded alternative lender, the bulk of their business is in the United States. So we can head down below and we can see the surge of results in terms of Propel. Like if we look to their first quarter 2024 earnings, we can see revenue of 96.5 million. In the entire fiscal 2023, they posted revenue of 316 million. I mean, we're looking at net income of 13.1 in a single quarter, whereas in the entire year of fiscal 2023, we're looking at revenue of only earnings of only 27.8. When we look to return on equity, it's much higher than Goeasy. It's outstanding numbers. They are certainly benefiting from, the current environment. And again, if we look to adjusted earnings per share, we're looking at 41 cents in the last quarter compared to 98 cents in the entire year last year. And overall, if we look to the, products and services, we have MoneyKey, which is primarily United States. We have Credit Fresh, which is again United States. We have Pathward, they're lending as a service platform, primarily the United States. And then we have Fora, which I haven't really heard of Fora all that much, but they provide open-ended lines of credit. They're a direct lender, and this is, the bulk of their Canadian exposure. And this is a company that is primarily utilizing AI in terms of, I believe on their underwriting side, it's AI powered, which I'm not exactly sure what that would do from a lending perspective. Maybe it would make approvals a little easy. Maybe, the computerized system can provide better underwriting skill than human, doesn't have as much human error. It can detect issues, borrowers that may, need to be rejected, or maybe borrowers that might have been rejected from a human underwriter, but with an AI system, it can kind of detect where, a loan might be feasible. So in this regard, I believe Propel is seeing some pretty strong results from its AI underwriting, which is, kind of surging its results as of late. It utilizes that AI to, look just beyond bare bones credit scores. And in that terms, it can probably issue loans to a lot more people that it might have overlooked otherwise. If we look to Propel's recent quarter, we can see revenue increased by 47% year over year, adjusted EBITDA 73%, net income 77%, adjusted earnings 81%, return on equity grew from 35% to 49%. I mean, loans and advances receivable, we're looking at 39%. And there's a little bit of dividend growth here. They paid a dividend of 12 cents. That represents 14% increase to their 2023 dividend. I wouldn't expect this to be as strong of a dividend grower as Goeasy Limited. I mean, they're a bit more established. They're not as fast growing. And I mean, overall, if we look here, it's kind of the same commentary as Goeasy. They're seeing huge consumer demand, record Q1 total originations funded. And overall, if we head down here, we can see the result. Loans and advances receivable, 49.8 million in 2020. We're looking at, 271 million as of their recent quarter. I mean, just explosive growth from this company. I will be the first to admit, I don't necessarily know the subprime market in the US as well. I don't know the regulatory risks there. I don't know how stingy they are on, total APRs, the lending practices, things like that. This has been one of the main reasons why I really haven't highlighted Propel all that much. I just don't know that market enough. I would really need to dive into that market. And this is one warning that I would issue for people investing in these companies. It is very, very important you understand the market they are working in. I personally would not buy Propel right now just because I do not know how the subprime market in the United States works. I mean, we saw Canadian regulators just recently axe the maximum APR that companies like Goeasy were able to charge, which didn't really end up impacting Goeasy all that much just because the bulk of their portfolio came in below the maximum APR, the new maximum APR. But in terms of Propel, I would really caution those who are buying it just because it's becoming popular right now. Make sure you research the subprime market in the United States, know the ins and outs of that market, know the regulatory risks, because these companies, the main risk with them is regulatory risk. We could easily see regulators come in, reduce those rates even further, which could impact these companies in terms of their net interest margins. It could, really impact their net income. So that's one big warning about Propel. Now, when we look from a valuation perspective on Propel, we can see that it does trade at a bit more expensive valuations than Goeasy. We're looking at 20x trailing earnings, but we're only looking at 8.1x forward earnings, which is cheaper than Goeasy. And if we look to the PEG, we can see there's a PEG of 0.13. This would indicate that the company is ridiculously cheap relative to its forward earnings growth, but I do believe that there's going to be, as this being a small cap US subprime lender, there's probably going to be a discounted valuation just based on the overall risks of that market and just the overall projection of that subprime market. And you're going to see why this company has such a low PEG when we go to the analyst estimates moving forward. I mean, we're looking at, they earned $1.12 last year. They're expected to earn $2.16 this year. That's 100%, pretty much 100%, just shy of 100% earnings growth. We're seeing in 2025, they're expected to earn $3.77. So this would be, north of 50% earnings growth, and they're expected to earn $4.22 in 2026. That would represent about 33% earnings growth in 2026. Caveat again, it's very hard for them to project this forward out. But the one thing that is pretty clear here is analysts are very, very bullish on Propel. Most targets have the company at $31 a share. Whereas if we look to Propel's pricing, I mean, their price just, even at the start of the year, we can go year to date, even at the start of the year, they're trading at $12. So, I mean, they've had a meteoric rise just because of the overall popularity of that market. I do plan to dig into this one a bit more moving forward. I got to get a big understanding on that US subprime market. And there certainly could be an opportunity here, even though the stock is up, 98% year to date. These companies, if they catch on, they can continue to run, especially with the growth of that subprime market. So if I were to pick one of these stocks to own today, it would certainly be Goeasy. It's been a company that we featured over at Stocktrades Premium for years now. I think we first highlighted it in 2018. But this is primarily based on just due to the fact as I mentioned, I don't know that US subprime market very well. I would need to research it a bit more, and there very well may be more opportunity in Propel Holdings. It's certainly the smaller company. It's certainly the company that is projected to grow at a much faster rate. And overall, both of these companies are rock solid operators in an industry that is, it's quite risky. That's one thing that a lot of people don't understand. The subprime market is risky. If, things hit the fan, ultimately it will probably be companies like this who face the harshest impact to earnings, especially in a deep economic downturn, to the point where the economic downturn that's driving the subprime market turns sour to the point where the loans aren't getting paid and, consumers are continuing to struggle. But overall, if you don't mind the approach that a lot of these subprime lenders take towards, consumer lending activity, a lot of people don't like them. I do view them as strong options moving forward. Just make sure they fit within your overall risk tolerance. So that's pretty much it for the video. Hope you liked it. Hope you liked this deep dive into the market and, a somewhat deep dive into these two companies. I do view them as appropriately valued relative to the growth. I don't really see either of them being too expensive, even though they've ran up. They've nearly doubled in 2024 alone. If you wanted to buy one at this point, I wouldn't necessarily say you're paying a huge price to do so. As always, everybody, head down below, like the video, smash the subscribe button, and make sure you comment. We're going to pick a random winner for a premium subscription at the end of July, and you're not going to want to miss out. And as always, stay tuned for more great investing content.